Make this easy. Monthly dividend ETFs are a real income engine, and the scale is wild. This is insane. The space has roughly $150 billion in AUM, and the leading funds target 9 to 13% yields, while many investors still settle for about 3% from old quarterly payers. You won't believe it, but the demographic fuel is strong too, with 10,000 Americans retiring every day seeking steady cash flows. I am George, and this is ChannelVest. If this helps already, subscribe and comment to join the crew. We will show how covered call funds turn market swings into monthly cash, which ones lean defensive versus growth, and where fees and flows tip the balance. We are about to unpack the legal ground rules next, so you know exactly what this show is and is not. ChannelVest provides research only, not an advisor, broker, or fiduciary. Education only, no personalized advice, no affiliate income, full disclosures and description. This content is for educational purposes only. Please consult with your registered financial advisor before making any investment decisions. Past performance does not guarantee future results. With that on the table, we pivot to the income revolution behind monthly paying funds. Here is the core idea. The income revolution is here because demand and design finally met. Roughly $150 billion in monthly dividend ETFs has emerged as retirees chase predictable cash. The average monthly ETF yield is about 9.19%, and traditional quarterly strategies hover near 3.24%. Translation: structure matters. Two quick takeaways. 1. Yield is cash paid each year, so 9.19% can materially augment a paycheck. 2. Secular demand is strong, with 10,000 Americans retiring daily, so the bid for steady distributions persists even when markets wobble. That frames the opportunity. Let us dig into which funds embody defensive, hybrid, and maximum income approaches. Make this easy. Three names dominate different styles. JEPI, the defensive king, shows an 8.41% yield on roughly $41.17 billion in AUM by mixing large caps with covered calls, defined as sell options for income. JEPQ, a growth income hybrid, targets the NASDAQ heavyweights and shows a 10.90% yield on about $28.40 billion in AUM, trading more upside for more tech risk. QYLD, the yield monster, pushes income toward 13.22% using at the money calls, but that can cap gains and weigh on total return. Keep risk and roll in your head. We compare it with hard performance numbers next. Time to break down results, performance, yield, and risk efficiency. VYM posted a 15.52% total return with a 2.92% yield, a classic dividend approach that rode a broad rebound. JEPQ delivered 7.20% performance plus a 10.90% yield, showing how options income can stack on top of returns. SCHD leads on risk efficiency with a Sharpe ratio of 1.03, meaning return per unit of volatility was best in class. This is insane because the mix of payout and participation can rival pure growth for real cash outcomes. We have the headline, "The fine print lives in the volatility truth," up next. Let me simplify what matters. Volatility is how much price wiggles. 3 audible takeaways. 1. Lowest risk champions show about 10.20% for JEPI and 10.30% for QYLD, reflecting consistent option premium smoothing. 2. Moderate risk players SCHD at 15.12% and VYM at 14.50% behave like diversified equity with dividends. 3. Higher risk, higher reward. JEPQ lands near 15.80% thanks to its tech concentration. The takeaway is clear. Choose your wobble to match your sleep. That gives context. We translate it into real stress behavior with drawdowns next. Let me make this easy. Drawdown is peak to trough drop, and it is where income strategies prove their mettle. During the 2025 shock, I fell about 13.26% and led the active pack defensively. VYM slipped roughly 12.31% among traditional dividend peers, and QYLD sank about 22.86% because aggressive calls can bite when markets lurch. 2 takeaways. First, payouts do not erase downside, they reframe it. Second, strategy design determines your experience during rough tapes. We have the numbers. Let us turn to what is actually inside these machines next. Here is the core idea. Composition drives behavior. JEPI spreads risk across quality large caps such as Alphabet at 1.70%, MasterCard at 1.62%, Meta at 1.61%, Amazon at 1.61%, and Lowe's at 1.58%, with sectors around technology 19.90%, financial services 13.75%, and healthcare 13.46%. AEPQ leans into tech concentration with heavy weights in Nvidia, Microsoft, Apple, Amazon, and Alphabet Class C, which amplifies both upside participation and volatility. Join the ChannelVest community, subscribe, and comment to shape our next deep dive. Cost Matter 2, we size the fee impact inside the expense battle next. Make this easy. Fees are the hurdle you must clear. Ultra-low-cost leaders include SCHD at 0.06%, VYM at 0.08%, and HDV at 0.08%, which helps long-term compounding. Active overlays charge more to run options. JEPI and JEPQ are about 0.35%, while QYLD is roughly 0.60%. Two takeaways. 1. Low fees boost what you keep in passive tilts. 2. Paying for an options overlay can be rational if it matches your income and downside goals. That was the what. Up next is the why behind investor dollars moving towards certain shops. Let me make this easy. Money flows tell you where conviction is. JP Morgan towers with combined JEPI and JEPQAUM near $69.6 billion, signaling trust in its covered call craft. SCHD attracted about $12.5 billion in 2025 inflows, showing persistent demand for quality dividend screens. JEPQ itself has grown roughly $15.8 billion since launch, a huge endorsement of tech-tilted income. You are with ChannelVest. This is your analysis. That is, performance and flows. Allocation choices show up in whether payouts can actually be sustained next. Make this easy. Payout ratio is dividends divided by earnings. SCHD shows 59.76%, a classic sign of sustainable coverage with room for growth. JEPI near 201.9% and QYLD around 449.86% reflect that option premiums and return of capital can supplement dividends to fund distributions, which is a feature, not a bug, but it shifts the source of your cash. Two takeaways. 1. Sustainability differs by design. 2. Know whether your check comes from earnings, option income, or capital. With that clear, we open the hood on risk math like beta and value at risk next. Here is the core idea. Risk metrics translate feel into numbers. Beta, moves versus market, runs about 0.60 for JEPI and 0.57 for QYLD, meaning lower swing than the market. SCHD sits near 1.00 and VYM around 0.91. Value at risk, loss at confidence. Over 1 day at 5% shows minus 1.68% for JEPI and minus 1.70% for QYLD versus minus 2.49% for SCHD and minus 2.61% for JEPQ. Two takeaways. 1. Defensive income strategies dampen shocks. 2. Tech tilt buys more upside and more VAR. The puzzle pieces are set. Portfolio mixes answer it in the model allocations next. Make this easy. Choose the niche that fits your stage. A conservative income approach for age 60 and above emphasizes monthly cash and capital preservation with heavier JEPI and staples like SCHD and VYM, plus a measured QYLD sleeve. A balanced growth income mix in the mid-career bracket blends SCHD, VYM, JEPI, and a JEPQ slice to capture tech while still getting checks. An aggressive income supplement for under 45 tilts toward total return with smaller income sleeves. Two takeaways. 1. Allocation is your true lever. 2. Rebalancing keeps risk in guardrails. We have the headline. The fine print lives in the community and content cadence coming up. Let me make this easy. This section is an invitation to stay close to the research pipeline. The message highlights subscribing and turning notifications so our dividend ETF analysis, market breakdowns, and strategy sessions reach you on time, and notes a community of hundreds of thousands learning together. Consider this your reminder that repeated exposure builds skill, not just hype. Here is the core idea. You can shape what we build next. The upcoming feature is the $1 million dividend portfolio with exact percentages, rebalancing rules, and tax optimization. There is also a Q&A segment fed by your questions from JEPI versus SCHD for retirees to how covered calls affect taxes and whether international dividend ETFs deserve a slot. Hit subscribe, drop a comment, and we will see you in the next breakdown. Goodbye and take care.